So good. What are we going to do today? Let me break it down. We're going to look at a couple of steps. So after finishing this presentation, which is going to take about half an hour at most, you will understand exactly what backtesting is, and you will be able to get going and improve your trading game. So before jumping into the deep end of the pool, let's talk a little bit about the challenges that traders face and how backtesting and a systematic approach to trading can help. Afterwards, we'll look into what backtesting is and how we can set things up and try and test things with the help of the free software called Trader's Gym, which is something that comes inside of the free platform called ThinkTrader, which is something that Thinkmarkets, the regulated broker, provides. So who am I then? And why should you spend the next half an hour with me? Well, my name is Alejandro Zambrano, and I started trading back in 2006. So I tested things, many different systems. I made money, I lost money. And over the years, I was able to find a trading system that works for me. And I've been profitable for many, many years now. I also been a professional analyst since 2009. So since 2009, I have been paid to watch the markets and try to help digest all the information available there to make it easier for traders to know what to do and how to manage your money. So I'll be doing that. So as you can probably guess, I have a wealth of experience. What I will try to do in this presentation is to, again, try to share some of my experience with you and make you a stronger and better trader by the end of it. So what are the challenges that traders face and how can we beat them? So the first thing is, of course, market volatility. How do you know the difference between a regular market volatility and a new trend? Well, if you have a systematic approach of trading and have backtested that, then you will know. So what is then systematic approach to trading? Well, it is when you have an idea, like a system that tells you when to buy and when to sell. So when to enter and when to exit the market. You can also add another element to that, which would be how much to risk the trade. But in essence, that's what all it is. Where to enter, where to book your profit, and where to put your stop loss. That's a systematic approach to trading. Now, if you have that system developed, then you should know what's regular market volatility. So what's the regular ups and downs in the market versus what's the new trend. And it is super important to know this. Imagine all the people that bought oil just ahead of COVID-19. Oil was trading sideways. And, if someone would have told you that oil would go to negative, so below zero, nobody would have believed you. But it did. The price went from, I think, $85, $70 a barrel to negative. So it went below zero. What does that mean? It means that if you held on to oil and you wanted to get rid of your barrels, you had to pay someone to take the oil from you. So not only did oil lose all of its value, it cost you money. And a lot of people lost the shirt on this. So it helps to solve this. What else? Well, the emotional decision making. You see, when you're trading, you take a position, the discipline goes out the window many times. Why is it like that? Because inside of us, we have to call the fight and flight response. And when you put money to back your ideas, so when you open a position, everything feels much more alive. And imagine you spend like a week doing analysis. You want to buy something. You want to buy Bitcoin, or you want to buy say you want to buy the S&P 500. You did your analysis. You think inflation is going to come down and interest rates are going to come down as well. And, the companies in general are doing good. So you really want to buy, and you do your analysis, and yeah, it all adds up. And then you buy, you go along the S&P 500. But then some news comes out and the market moves against you. Now you put a bit of money into this position and now you're feeling distress and you start to question yourself. Well, maybe I didn't do my analysis good enough, or maybe this will change something. Maybe I'm going to lose all my investment. And this is very common, even though it's probably just noise. And that's emotional decision making and when you're trading, because in your brain, we're built, we hate pain. Like, we don't want pain. We do everything to avoid pain, and we do everything to avoid uncertainty. So because of that, we make all these emotional decisions and we lose money on the back of that. Now, imagine you'd done your homework, you did the back testing, then you would know, all right, this is actually just a blip. It's not a new trend. Is literally just a blip against the general trend. And if I just wait a couple of days, I'm going to be fine. Backtesting helps with that. The other thing as well is strategy complexity. A lot of new traders, they spend a lot of time on their system and they add way too much indicators and different factors that go into the into the trade. With the help of backtesting, you can easily figure out what makes sense and what does not make sense. So what the backtesting does, it helps you to fix all these problems in conjunction with a systematic approach. Now, we covered a little bit of the whys, like why even bother, right? We know now we can fix all those three things with the help of backtesting. But what is backtesting? I'm talking a lot, but I haven't really given you the definition yet. So backtesting involves applying a trading strategy to historical data. It's as simple as that. So with the help of the historical data, we try to figure out, what patterns work, how much money we can make based on trading on these signals that we have derived. What's our potential risk? And the process is quite simple, and it depends really on what you're aiming to do. So for example, if you day trading, you want to trade in the morning or go in the morning and get out by the evening, or just do several trades throughout the day, then you would probably look at daily data, data from the last, say, 90 days, maybe 100 days, and you will see how your strategy worked. On the other hand, if you want to trade slightly longer term, then you might use the last 20 years of data to try to understand how your system would have worked. Now you apply your strategy to this data, and then you just analyze the outcome. And from there, you can see if it makes sense to use the system or not. You can also see if you can optimize, take profits, stop losses. Now, what are the limitations then? Well, what a lot of people do when they start looking into backtesting is that they try to find the holy grail. They try to find a system that works 80, 90% of the time. So they adjust all the parameters so they have the correct answer to everything. The problem with that approach is that when you usually have something that is over optimized, that is not going to work in the real market conditions. So don't fall into that trap. The other thing as well is that what may have worked in the past might not work in the future. Now, if you look at a chart from 1930s or 1950s, 1960s, if you look at a chart from there and you remove the price and you remove the time, you wouldn't be able to tell, oh, this data is from 1950s and this data is from 2023. Well, you could a little bit because there's more gaps in the data from the 1950s. Gaps means that there's more sort of prices that the price never traded, okay? But in general, you wouldn't be able to figure things out that easily. So historical data looks very similar to modern data, but the problem is that things change, okay? Things change. And when you look at humans, we are interacting with the market. You look at the price is going up, your buddy's already bought, and you want to buy as well now because you don't want to miss out. We're influenced by the data. The price starts to go down, everybody gets panic, everybody closes out, and because they close out, the price goes even further down. So you have these strong trends. Now, that means that correlations and things that worked in the past don't always have to work in the future. However, everybody that does this professionally, they do look at what happened in the past, okay? That's the starting point, right? We looked at other people's experiences and then we try to apply that and make our own, the good experiences, yeah? So there is some truth to it, but just because something happened doesn't mean that it has to happen in the future, so bear that in mind. So how can we implement it? Well, there's several ways of doing it. In this presentation, we're gonna address what we call manual trading. But the way it started out, I would say, is coding. So coding pretty much means that you take and write a computer code. So you would literally write, well, the market that drops 3 days in a row, buy it, and then sell it 3 days later, for example, and you put a stop loss 5% lower than your entry. That's a simple strategy, and you would code that, and then you see it. Now, the benefit of coding is that you can actually get a lot of numbers very quickly. You can literally run that code, and then you get the last 100 trades, the last 200 trades. The problem with coding is that it's difficult to implement many different factors, and it also doesn't weigh the different factors, okay, to make a decision. So you can spend many hours, many years really, trying to find something that works when you're coding it versus when you're doing things manually. When we're doing things manually, maybe you'll find your chart pattern, your indicator is there, but you also read the news, so you know that a new president was elected or certain information about the labor market was shared yesterday, and that adds to, say, the bullish bias. So you can weigh things, then you can take smarter decisions. So manual trading, many times, manual backtesting is superior for most people just because it goes quicker and you can do all the weighing in. Now you have, of course, AI, but there's no readily available tools out there for you guys to literally just let AI do all the homework for you. But the idea with AI is that you use a combination of coding plus human intelligence to make things, because the AI tries to replicate the human intelligence and they can do all the weighing. But not only that, it can go back through history and see, many traits to get an idea what's going to happen in the future. So what do you do then? Well, we're doing manual. So what are we going to do then? Well, again, we need to have some sort of a system. So a lot of people load indicators. They look at chart patterns. If you can try to incorporate news, even though it's much harder. You can look at correlations between different asset classes. If you scalping or trading short term, the time of the day will impact your trading, and sometimes even the day of the week. If you are a swing trader or position trader, which means that you hold positions for a couple of days, a couple of weeks, then that matters less. Now you look at all of this, and then you look at the sample length. You figure out a system, you test it, and ideally you have a longer sample length. In other words, you look at many trades. I used to say 30 trades. Well, when I went to university, they said 30 observations. Now the 30 observations, what they said, is related to the natural world. Like if you take a rock and you break it in half, there's just a certain amount of things that can happen with the rock. The problem here, or the good thing with the rock, is that the rock doesn't have an opinion. It's not gonna change its reaction just because, it's me hitting it or somebody else hitting it. If we're hitting it with the same tool, realistically, it's gonna have the same outcome and it's gonna break. Now, with the rock, again, it doesn't change. Humans, we change. We react to the data, and the data reacts to us, okay? And that just makes things a little bit challenging. But what I suggest is at least 30 trade observations, ideally maybe up to 90, so you can have a better understanding of how the market works in different weathers, sort of different market conditions. Now, the other bit of backtesting is that you can do something called forward testing. So when you've done your homework, when you tested your system, some people jump into what's called forward testing, which literally means that you test the market, test the strategy on the real market by putting it into a demo account, for example. Demo accounts are readily available. A demo account is literally an account that lets you trade with dummy money. The problem with the demo account, though, is that it takes time. You put a position on, and then a few hours later, maybe it triggered or didn't trigger your idea, that is, and then you need to do this. I don't know, 1 month, 2 months, depending on your risk appetite, right? With backtesting, you can compress that. You spend one weekend and you tested your strategy on all of this year's data, so you can compress things. I have a ridiculous amount of experience trading the markets, but you can also learn that by just using backtesting. You can literally go through the data and you can be at a level where other people are, where you're at my level, pretty much. Let's move along here then. So how do you get access to the tool we're going to use, the backtesting tool? So it's actually quite straightforward. You will pretty much need to get something called ThinkTrader, which is a free tool. ThinkTrader is a trading platform. It's very user-friendly. You got advanced charting tools. For example, if you're into the Japanese candlesticks like Renko and Heshinaki and all these different ones, we have all of them. If you go to other chart providers or other platforms, you usually have to pay for them as premium services. We get them for free here. You have as well very fast execution. Why does this matter? Well, imagine you trading with a big position and you put a stop loss at 100 and the price reaches your stop loss. Well, you want to get out at 100. You don't want to get out at 99.5 or 98 or 97, whatever. You want to get out at 100. They have very robust systems helping you to get out at the price that you want to get out, as well the way you when you're getting in. That's really important, especially when you start to trade with bigger positions. They have, of course, all the risk management tools I'm going to show you in a few minutes. And you can trade everything like Forex, CFDs, commodities, ETFs, and they have Traders Gym, and that comes included for free, and you find it inside of the application. So if you look here, this is the platform, is the night version. You can easily change here to a day version if you want to. And you have this dumbbell. You click on that dumbbell and ThinkTrader's load. It looks like this. You have your different simulations on your left, and then you have any positions closed or opened. So to get going, we pretty much just click on this button up here, and it's going to ask you which market you want to do the analysis on. So you have the different categories here. You can just search. There's 3,700 markets to backtest on. So you have a wealth of data here that you can use all for free. In my case, I wanted to use gold, so we press on gold. This is the simulation settings. So this is the name, so you can name the simulation. And that is to be able to differentiate the different orders you have. So I'm gonna name this, and we're gonna call it webinar. Then you can choose the time frame. So you wanna load 1 minute data, 5 minute data, 10 minute data, 15, 13, 1 hour, 4 hour, all the way up to 1 month. If you're doing swing trading, position trading, then the daily data is usually good. You can also just charge afterwards. You can just change many times, but you wouldn't necessarily need to load the 1 minute data if you want to hold positions for several days, because you don't need that granularity. And then you have the interval. So you can see here, this is from 2019 all the way up to 2023. You can manipulate this as you wish. Of course, if you go for the 1 minute, it's just going to offer you less data points. Well, actually, it's more data points, but the time interval is going to be less because it takes forever to load the data. So there's always limitations on that. Now, the way it works is this. It's going to generate this. It's going to go and fetch this data. And then you have the trade date. So the trade date is usually in the middle of the interval. So you're going to go, if you go to your left, you're going to see the historical data. And then you press a play button. I'll show you that in a minute. And it will simulate the future candles. And the trade date is usually in the middle. So you simulate. So you have half of the data here, and then you simulate the rest. And then you click on create. It looks like this. Very straightforward. You can see here, gold webinar test, November 20th. Did this 2 days ago. So this is gold prices, daily chart. What do we do? So depending on your strategy, you can sort of draw, you can add indicators, and you can change the charts if you wanted to. You can change the time frame as well. And then here, if you do nothing and you just click on play, then you'll see that the data starts loading. And that's what we call a trader's gym, because you're part of seeing the data as it develops. And by looking at the data, you become stronger and you become better at understanding what's happening, what's the natural rhythm of the market, and so on. You also have a little button here. You see this is 1x. You can click on that to speed things up. I usually put it on 10x, so we don't have to wait too long to see the trade ideas develop. So let's imagine here. Okay, I am a chart trader. I primarily trade the classical chart patterns. So what I'm looking at here, I'm looking at gold. So this is the gold, the peak we hit in 2020, and then the market was coming down and we have a wedge. So usually when you break a wedge, you tend to have quite a strong bullish push to the upside. We also trade above resistance level. So we could technically try to go long on the dip here if we wanted to, but we could also maybe add more indicators. So for example, I added the RSI here. And my general idea here, let's just imagine, and I say, well, we have this breakout, but with high interest rates and the Fed raising interest rates, now how much higher could this go up? Remember, this is in 2021. What's going to happen next year? And the war as well in Ukraine, I think everything started to slow down at that point, if I remember correctly. So I'm going to, for the sake of it, I'm going to be a contrarian. I'm not going to go long here because I also know that most of these patterns don't work. They only work some years and then other years they don't work. So let's short. So what I do is I literally open a position. So the dashboard looks exactly as you would do when you open a regular trade. You can press sell, which I did, and you would either put that market order or limit order on. You would choose your amount. You can see the cost per pip, and you can see the margin you're going to use. You can activate the stop loss orders. So this is quite neat, actually. For example, when you take on take profit, you can actually see how much you're going to make and lose before even opening the trade. So long gone are the days when you were trading on the MT4 and MT5 platforms, when you had no idea how much you were going to make or lose before you open the trade. You can actually see here exactly how this is going to develop. And then I just click sell. So you can see here, down here, you see the position is open. So it's active position is the webinar test in gold. It's a sell position. I sold 10 lots of it. And this is the date. This is the open November 18, 2021. This is the open price. This is current price. This is my P&L. This is my take profit. This is my stop loss. You can go in and edit this like if it was the regular platform. You can go in and edit this. And then when I'm done, I click on play. So it starts to load. You can see the price is coming off a bit, and I'm short, so I'm up a bit. Then you can see the price move down, and then for 1, 2, about 3 days, not much happened, and I have a bit of profit. And then after a week or so, we're down. So you can see if I want to trade on this type of trade idea, I have to wait a couple of days. So now you learn that now. You know that, okay, if you short, you have to wait a couple of days before you hit the take profit or you hit your stop loss or the market goes in your direction. So you learn that because trading is a lot about patience many times. It's just about waiting. So we see we went down. So now remember the take profit is at 17.89 and this is 18.16. So what would normal people do here? They would probably just book profits here because they have a nice chunky profit and they'd be like, all right, I got a 1-to-1 risk reward ratio. Let's just book profits here and then let's walk away. And that's what I did. I booked profits. So I closed out at 18.09 to be exact. So way before the take profit. Well, not way before, but before the take profit. And this is the beauty. This is the beauty of the system. We let the simulation continue. And what would have happened? Well, 1, 2, 3, 4, 5, 6, 7, 8. About 8 days later, we would have hit the take profit. And we would have made around $30 more by holding this position open for longer. So it would have made another $300 on top. The thing here, though, is that we would need to have wait some 7 to 8 days for the price to reach the take profit. And again, this is the beauty of the system. Imagine we do this 30, 40 times, and every time, well, not every time, but a majority of the time, we exited the market too early. What would you have done when you would have traded this with a real account? Well, you would have kept the position open for longer and trusted that the take profits you designated from the beginning, that you would have waited for that to be met. Remember, when you are trading with real money, your thinking becomes more short-term instead of long-term. So when I put the position on in the beginning, it made perfect sense to anticipate. It's fully normal. Look at this. It's normal for the price to go back sort of into the meaty part, go below the trend line and go below it if it's a false move and if the market indeed is overbought. That's normal, right? In fact, when we closed here, the RSI was sort of back to the midpoint. It wasn't even oversold yet. The RSI started to trade sideways and then sort of settled. It didn't go extremely oversold. So from a rational perspective, we should have kept the position open, but I didn't. I closed out early. And that's exactly what you can do with back testing. That's what you can do. You can test for all of this. So how do we interpret the results then? Well, I suggest at least 30 trades to get a good base, but ideally up to 90 trades you collect like this. You figure out the profitability percentage. Are we going to win 50% of the time, 40% of the time, 70, whatever it could be? What's the average profit and what's the average loss? And when you have those three parameters, you can actually figure out what will be the long-term outcome of this. So when you have data for 30, you can actually figure out, okay, if I do this 1,000 times, what's going to be my potential profit if the relationship and the percentages remain the same? And from there, you can draw conclusions if you want to use your system or not. When you have the data as well, as I mentioned before, you adjust for the entries, you adjust for the stops and the take profit orders to try to improve the outcome. And then when you have that, you can always take the strategy and see how it worked in another different interval. Did it work like in this case, we're using data from 2021, 2022. But what if we would have tested this in, I don't know, 2015? Yeah. If the conditions were similar, then you would assume that the results would be similar. But is it true or not? You would test that. And what if you figured out that the system was a complete sham? It didn't work at all. Well, you would have learned something and you would have saved a lot of money because you tested the system on a simulated environment, so you would not have lost any money. But you know what? Sometimes, imagine that you find a system that is wrong 80% of the time. Maybe you want to flip that system, and instead of buying when the system tells you to buy, maybe you should be selling. A lot of people have actually discovered this. The classic RSI indicator is when the market is overbought, you sell, and when the market is oversold, you buy. But a lot of people, especially in the crypto world, have discovered that when the RSI is overbought, you should actually buy that cryptocurrency because it usually just continues to head higher. So what worked in the past doesn't always work in the future. And you can all discover this all for free for zero cost with the help of Traders Gym. So how do you get going? Very straightforward. Thinkmarkets.com, you go there, you create open live account, choose Think Trader, and then you just need to fund it. Any money unlocks Traders Gym, but there has to be some money there. Now, what I recommend you in terms of funding, everybody's different. You need to take your own decisions, but what I find worked really well across the world, because I've been across the world talking about trading, I tend to say to people, maybe work with 1 month of net income. Why 1 month of net income? Well, because what you make in 1 month is different to what I make in 1 month, and what somebody in, say, Mexico does in 1 month, or the Philippines or UAE, right? Now, if you have 1 month of savings in your trading account and you would double the account, well, you had an extra month of income. I mean, that's quite nice. You can probably, do a few things with that. On the other hand, if you lose that money, then 1 month of income, like, it's not gonna change the world necessarily for you. So that's where I usually start. So again, very straightforward. Think Markets is the way, and then Think Trader, and then you're ready to go.